Welcome to the Purpose-Based Retirement with certified financial planner practitioner Casey Weed.
It's not how much we make during the good times, it's how much we keep during those really bad times.
Casey leads a team of financial advisors with decades of experience, helping families across the country retire with the confidence they deserve. The Purpose-Based Retirement assigns every dollar you've saved a specific purpose to meet a key retirement need.
Whatever risk you faced, we've got a plan for that.
Stay tuned and learn how you can look forward to a worry-free, purpose-based retirement.
Good to see you again. Glad you're here for another episode of the Purpose-Based Retirement. I'm Lee Kelso here with Casey Weed, certified financial planner and the president of Howard Bailey Financial. We're going to begin the program today talking about a situation that has many people in retirement in disappointment, and that is interest rates. They are disappointing right now.
Yeah, a lot of people are really concerned with the interest rates they're getting on not just their bonds, but also their CDs. I've had many folks that are coming into our office today that are concerned about getting a fixed rate return or where they can put their safe money because they don't want to take risk. And that's why my grandparents were. You know, a lot of the money was in the house. Heck, they weren't making any interest on a good portion of their retirement savings. And now I've got those same individuals today coming into my office saying, I don't want to take any more risks than your grandparents ever wanted to take. And they want a fixed rate return for at least a portion of their portfolio. Maybe it's 10% of the portfolio. Maybe it's their overflow emergency fund over and above what they're keeping in savings and checking. They got 6 months in emergency funds and saving and checking, and then they want to keep the rest, you know, someplace, maybe 1 or 2 years worth of expenses, you know, someplace where they're earning some type of return, but that's better than the bank or better than they can get in CDs. And sometimes we have to look at things that aren't CDs and aren't bonds for that matter, especially in this interest rate environment, to get ourselves a better rate of return on our cash.
Let's jump in real quick with just a quick look at some interest rates that are out there in the marketplace and illustrate really just how flat the market is right now. My gosh, money market rates are next to nothing.
Yeah, money markets right around 1%, 0.85% to 1.4%. My dad just the other day said, well, they'll give me $500 to open up an account. It's paying 1.2%. Should I do it? Well, why would we even do that? You know, when there's places out there where we can get, you know, 1 to 2% in a CD, but 2 to 3% and a multi-year guaranteed annuity. And then even for me, I'm going to use an IUL or an index universal life policy that's structured that keeps me totally liquid, takes care of some death benefit, long-term care benefits, you know, that are there for me that I need. But now if the market goes up 20, I get 10. If it goes down 20, I don't make anything, I don't lose anything. But I would rather, instead of putting it someplace where I know I'm only going to get 2 or 3%, let me put it someplace where I know, well, I can make as much as 10% this year, or maybe I don't make anything, because 1 or 2% is really, might as well be nothing.
Yeah, it might as well be. What did you just call that?
That was an index universal life policy that I used for myself and also my family, and that's what Dad ended up doing. Instead of going to that money market, he ended up using one of those IULs for some of that cash, picked up a nice little death benefit that's probably the most likely use of the dollars, but now it's someplace liquid, it's someplace you can have it back at any time. There's no penalties like you have with a CD or an annuity. The principal's protected, and he's probably going to make 4 to 6% over time. You know, next 12 months may make 10, may not make anything, but you know, he knows it's safe just like it would be if he put it in, say, a fixed annuity for that matter. It's just not tied up and it has a little bit more flexibility.
Any kind of minimums for that?
Yeah, typically, I mean, it depends on your age, but typically that's around $50,000 to $100,000 before we find the ability to really set those dollars aside. So it has to be structured for the right person at the right time in their life in order for it to work. And we have to qualify in order to make that work at the same time. Not everybody can have this. You know, it's something we have to qualify for, and we have to meet certain minimums in order to have this vehicle as part of our portfolio. And it's not typically the first place we go. You know, we take care of our basic emergency fund, we take care of our income strategy, we take care of our inflation strategy, and then maybe if we have something left over after we take care of you and your retirement needs, now we're setting something aside in this overflow emergency fund that will probably ultimately be passed on as a legacy tax-free.
What do I need to know about these multi-year guaranteed annuities? Of all the options that we showed just a moment ago, they had the best interest rate.
Yeah, well, I had a couple that I remember coming in here over the last couple of years. I believe they came in for the first time back in the fall of 2016, and they were beginning to sell their farm. Now, that farm meant the world to them. They weren't possibly going to sell this thing, and so that they ended up doing was they took that farm and they started selling pieces of it, you know, a small piece at a time. They didn't want to take risk with the dollars that they were liquidating, because it was blood, sweat, and tears of generations. And they wanted to put it someplace where they said, I want to know I'm going to get a return on my money every single month. So, well, we can't do that in the market. We can't do that with an indexed annuity or an indexed life policy. I mean, the only way that we can do that is with a CD or some type of vehicle such as a fixed annuity or a multi-year guarantee annuity like this. I mean, even if we were to do it in, you know, that indexed universal life environment that we talked about a minute ago, next year we might not make anything, you know, but we could make as much as 10%. Well, I might think that's a better place to go. He wants to know he's making money every single month. And so we took him and put him in a place that he's guaranteed 3.5% per year, every year for the next 5 years. He opens up his statements every month and he's excited because he goes, I'm making money, and they're living off the interest. You know, it's more than enough interest that they can live off of. You know, they're not big spenders. They're happy. Give me 3 to 4% and don't lose. And many of the people we work with do fall in that category. You know, not everybody, you know, everybody wants to make 6 to 10%, but not everybody wants to take on the risk or has the mindset to go through what it takes to get there. It can be stressful if you're not comfortable with those major fluctuations that the market takes. And if you go from a point where it was all in real estate, you didn't see that statement every month where the value of that property was going down and it was going back up, now getting a statement where, yes, I might make 6 to 10% a year, but next month I'm down 10 grand, the next month I'm down 50 grand, then I'm up 20,000 the next month. That can be very stressful for someone that doesn't really want to experience that, I think, more than anything else. And getting them 3 or 4% a year sets that peace of mind right where they can really enjoy the retirement and do the things that they wanted to do. Not right for everybody, but for them it was great. CD investors, I had an elderly lady that came in that had everything in CDs. These CDs were coming due and she was renewing them at 1%, 0.5%, 2%. When we were able to get her 3.5% fixed, she was happy as a lark.
Yeah, I can understand that. What if I decide that I'm just going to wait? We seem to be in a rising interest rate environment now, or at least it looks like we're going to see an increase coming soon.
Sure. And we could wait. You know, it's just that interest rates have to rise quite dramatically and very quickly in order for it to be a good thing for you to be just sitting on your hands at this point. What we've found and what we want to share with you here later in the show is that interest rates really need to rise by about 1% a year in order for us to say that it's better for you to wait and say only make a 1-year investment today instead of a 5-year investment, which is probably the difference between making 1% and 3%, and that all comes down to compound interest. It also comes down to the taxes that you'll have to pay as well. When you look at a CD, every single year your interest is taxable. Every single year you have to you get a 1099 that you have to file, and that drags down your net return, as you can see from this example. After 5 years with a 1% CD, $500,000 is worth $520, but $519 after tax. With a 3% fixed rate, now it's tax deferred, and not only did it grow to $580, then after tax it's still a better deal at $560. So interest rates have to rise dramatically, and once we factor in tax benefits of a fixed annuity like this versus a CD, there's really no comparison.
All right, so if you're not really sure where you're at and what might be best for you, one opportunity is to call us right now, and we'll set up a complimentary review of your entire financial and retirement plan. A chance for you to learn more about your money and learn, for example, the fees that you might be paying to work with your current advisor you may not know about. We'll begin work on a tax strategy to show you how you can keep more of your money, and then take a look at a long-term income strategy so you can have a confident retirement and spend with confidence in those golden years. All those things are available with some planning. We hope you'll be one of the first persons to call right now at the number on your screen, and we'll set up a complimentary review, some time on the calendar with Casey or members of the Howard Bailey team, and get you started down the road toward a purpose-based retirement. Okay, when we come back, it's time for us to answer some questions from you, so stay with us.
At Howard Bailey Financial, every dollar has a purpose. We call it the purpose-based retirement. A certified financial planner will help you decide what you need your retirement money to do for you. We put together a written plan that puts your dollars exactly where you want them to be. And we put every dollar to work to maximize your retirement efficiency. For a higher level of insight and care, choose the purpose-based retirement from Howard Bailey Financial. Call us now to set a complimentary consultation.
You need a plan to create the retirement you deserve. The first step is to tune in to the Purpose-Based Retirement Radio Hour with Casey Weed and Marshall Johnson. Saturdays at 11 a.m. and Sundays at 1 p.m. on WOWO 107.5 FM or Sunday mornings at 11 on 95.3 MNC.
And welcome back to the program. Each week we answer questions from viewers in this segment, and we're going to start today with Dan from Cherubusco.
My wife and I are in our mid-40s and feel like we have a pretty good handle on our finances. Retirement is still a good 20 years out. I don't want to incur any unnecessary expenses, but would like to know we are on the right path. When do you think is the right time to meet or hire a financial advisor?
Well, Dan, I think there is a difference between meeting and hiring a financial advisor. I think one of the misconceptions that a lot of folks have is, meeting with a financial advisor is like meeting with my attorney. Every time I ask a question, I get charged a fee. And that's not necessarily the case, depending on the advisor you work with. There are some advisors out there that operate on a fee-only basis or a fee basis to put together, financial plans, and even just to sit down with them, it might cost you a few $100s. But what I believe is that you should be able to sit down with someone, have them give you an objective opinion over what's going on in your overall financial life and see if they can add value. And if they can add value, then maybe they end up getting you as a client. Maybe you end up hiring them and entrusting them with your life savings. But that doesn't have to happen. There's a difference between meeting and hiring a financial advisor. For instance, when you come in and meet with us, we may spend an hour, we may spend 2 hours sitting down just getting to know each other in that first session and answering any questions you might have to see if we can really add value to your overall situation. I've got a CPA that came in after calling in after one of our TV shows a couple of years ago, and when he came in, we sat down, we had about a 45-minute meeting. He loved managing his investments and he was doing a great job. He just wanted a second opinion. We had offered him that second opinion, but more importantly, we actually were able to add some serious value to his bottom line when it came to tax planning. And we parted ways as friends and we added a lot of value to his life. So that's why it might be worth a half an hour to an hour of your time, or maybe more, to sit down with a certified financial planner and see if there's any gaps that they might actually be able to fill in your overall financial plan. Now, when it comes to timing, at what point in my life do I go and see a financial planner? I kind of think about this like seeing your doctor. I go in for my doctor every year and I get an annual checkup. I don't plan on dying anytime soon. I'm not planning on getting sick next week, but I go in, I get an exam, I get an idea of how my general health is and if there's any changes that I need to make. And from time to time, they might use a different medication. Unfortunately, things like cholesterol medication, even at my age, I need to keep an eye on those things. And, whether you're 25, 35, 65, or 85, and especially if you're in that red zone, within 10 years of retirement, 5 years into retirement, the decisions you make at that point many of them are permanent, and there's never a better time for you to educate yourself on all of the tools available, all of the services available to give you the confidence you really deserve. So I think annually is a good time to get a checkup and sit down and potentially meet at the very least and potentially hire a financial advisor. Do it periodically, and that drop dead date is that retirement red zone.
Yeah, that physician analogy makes a lot of sense to me. That works.
Yeah,
that fits. Let's get back to questions now. We're going to go to Joyce in Noble County. Joyce?
Casey, how does somebody budget for health care when you retire prior to Medicare age? And, looking at all of the finances, the volatile market right now when it comes to health care, I know from experience firsthand that this can be a tough question.
Well, Joyce, there's no question that healthcare is a very volatile place today, and it's a big concern for almost every single person that walks into our office. There's this huge question mark and huge concern regarding which way those rates are going to go in the future. Hopefully they go down rather than up, but it just doesn't seem to be working out that way. And one of the things that we often want to do is we want to sit down with people and we want to stress test their income strategy. How much additional income can we take above what our planned income is and still make the plan work? So if now we've got an extra $500 or $1,000 or $1,500 a month we know that we can take if we do retire, that can give you a lot more confidence in making that decision. There are also things that you might want to start doing now if you're not at retirement yet, such as making HSA contributions. If you're on a family plan, you can make up about a $6,800 tax deductible stable and tax-free growing contribution every year, and that can be something that can help you kind of budget for some of those additional expenses. And also, don't overlook Medicare. You know, a lot of people come in our office and they say, well, I just need to get to 65, or I'm going to retire at 65, all because I get on Medicare. And the reality is, and this is a big surprise for a lot of people, is that Medicare is not free. It is expensive at times, especially income dependent. If you have a little higher income, you may actually be paying more for your Medicare than you were on your company plan. It's easy to project $200 or more a month per person just for Medicare. So don't overlook that either, and make sure it's incorporated into a financial plan, and make sure there's a different inflation rate attached to that as well. Healthcare traditionally grows, the expenses grow at about twice the rate of our bottom line inflation, such as CPI. So you want to incorporate that in there, and you also want to take it out of places like your mortgage. A lot of retirees will put an inflation rate on their whole expense package, when in reality your mortgage isn't going to increase every year, and that might be a major part of your expenses. Your health care definitely will. So things to keep in mind.
Next question is from email, and it comes from Brenda in Granger, Indiana. And Brenda's asking, I've been investing in mutual funds for the last 20 years, but I hear and read a lot of negative information about them today. They have treated me fairly well. Is this just a sales pitch, or has something really changed?
Well, Brenda, the reality is something really has changed, and things are always changing in the investment world. There are hundreds, if not thousands, of different investments today than there were just a few short years ago, and there's better ways of doing things, especially when it comes to mutual funds. You know, if you go back to the 90s and you walked into a financial advisor's office and said, hey, I've got $200,000 or even $2 million, and said, hey, will you manage this for me? And say, oh, yeah, sure. And they'd go throw it into this mutual fund, get their share and their commission up front, and they'd say, hey, well, maybe we'll just rebalance once a year or twice a year. And that was kind of how that worked. And what that resulted in is it resulted in a lack of transparency. You don't know which holdings you actually have. Is there overlap between all those different mutual funds that ended up with additional costs, and a lack of transparency in that cost at the same time? The average mutual fund today, the Wall Street Journal did an article a couple of years ago finding that the average mutual fund costs about 1.5% a year, but then the hidden expenses that aren't legally required to be disclosed, transaction costs, for instance, on average double the cost of that mutual fund. And you also have tax inefficiency. You know, when your neighbor, or if anybody else that's part of that pooled investment, wants to take a distribution to put a new roof on their house, or if they want to buy a new car, you end up paying not only a portion of their transaction cost, but those tax costs of those positions that are in that portfolio are also passed through to you. And today there's ways that you can have a portfolio that's managed exclusively for you by a team that's not just watching it once or twice a year, but every single day. And there's huge opportunities in the tax world in making that transition out of the mutual fund world into the separately managed account world, or third-party managed world, where you now have the ability to do things like tax harvesting on an annual basis. Right before the end of the year, they can do some really neat things to make sure they're generating some additional tax deductions on some different positions that are still held in the portfolio at the end of the year. So yeah, there's a lot of opportunities out there that are a lot different today than they were 20 years ago, and definitely when it comes to mutual funds.
All right, so if you have a question you'd like to have answered here on the program, just email us at info@thepurposebasedretirement.com. But now for the next 10 callers, we have a special offer. It's an opportunity to really learn more about your money, a complimentary review of your entire financial and retirement plan, a chance to uncover what it might be costing you to work now with your current advisor, beginning put together a tax strategy so you can keep more of the money that you make, and then taking a look ahead to create a lifetime income scheme so that you never have to worry about cash again. You can live comfortably in retirement. Those things all sound great, don't they? All you have to do is be one of the next 10 callers to call the number on your screen. And Casey and the Howard Bailey team will make time to sit down with you and give you your very own purpose-based retirement. All right, here's our question of the day. Which of these activities does the average American spend the most time on? We'll have the answer when we come back.
Let me help you create the retirement you dream of. Go to my website and pick one of 3 education options to get started today. Get a copy of one of my retirement planning books, sign up for a Purpose-Based Retirement live event, or go to the Purpose-Based Retirement University. 2 days of college-level retirement planning instruction. With the right education and proper coaching, I believe anyone can create the retirement they dream of. It all begins with one step. Visit thepurposebasedretirement.com.
You need a plan to create the retirement you deserve. The first step is to tune in to the Purpose-Based Retirement Radio Hour with Casey Weed and Marshall Johnson. Saturdays at 11 a.m. and Sundays at 1 p.m. on WOWO 107.5 FM or Sunday mornings at 11 on 95.3 MNC.
Heading into the break, we asked our question of the day. It had to do with how you spend your time and what's most important. Which activity does the average American spend the most time on? Casey, which one of these is correct?
Well, Lee, unfortunately, the answer is actually B, selecting a restaurant. I know that's not me. I typically hop on my, Zomato app or my Yelp app, find the closest restaurant that's highest rated, and we're going out to eat. Now, on the other hand, when we take a look at the average American, they are actually spending more time hunting for that restaurant than they are actually planning for their retirement. TIAA-CREF found that Americans spend less time choosing their IRA investments than they spend choosing the next restaurant they're going to go to. I myself definitely spend a lot of time shopping around for a tablet, shopping around for a TV for that matter. However, my wife and I were sitting down every quarter for at least an hour and reviewing our overall financial plan, and you should be as well if you want to have a successful retirement. CNN Money says that workers spend more time planning their vacation than their retirement, and I could say it's probably because of this. Many times I find that individuals don't want to take that dive into beginning to plan for their retirement because they're intimidated by the process, feeling that it's much more complex or complicated than even planning for their next vacation. However, what we want to do today is we want to walk you through each one of the different ways that you might start to plan for your very own retirement. We're going to be using an article written by Michael Kitces. He puts out a lot of great information on financial planning, especially retirement planning, that I think we can learn a lot from. We're going to walk you through the history of financial planning. We're also going to walk you through each one of these types of planning and which one might be right for you, if not all three. That first one is the modern portfolio theory. Now, that was developed back in 1952 by Harry Markowitz. So really not all that modern anymore, right? If we're talking about something that's truly modern, we'd think it was something that was occurring today. And what was created back then was really a framework for portfolio or investment allocation. And that was really how financial planning got started. It was all about investing, and it's evolved into much more than that, especially as retirement has been brought to the forefront with the baby boomer generation. If we look at the efficient frontier, what it really told us is that between stocks and bonds, using those two asset classes, for each additional degree of risk, an investor would be only willing to take on additional degree of return for every degree of risk that they would be adding to their overall portfolio. And there would be one particular spot on that curve that would be the optimal portfolio for your investment future. However, now it becomes to be a little bit more about purpose than anything else, especially as we step into retirement. We begin to think about our needs, our wants, and our wishes. That would be another way of doing financial planning, which is the hierarchy of needs. The rectangle approach is the household balance sheet. So we're really taking all the assets that you currently have, your pensions, your social securities, your IRAs, maybe even the equity in your home, and we're allocating that and saying, well, can we cover all of our future liabilities, our future expenses? Inflation is also a liability, as well as any potential health care expenses, long-term care expenses, and also taxes. If our assets can cover our liabilities, then we're in a good position. Now, at Howard Bailey Financial, what we do is we incorporate all three of these different approaches, and we do it in this fashion. We start with the rectangle approach, the household balance sheet approach. So at this point, we're taking a look at the possibilities. When a couple walks into our office, we're going to take a look at their overall allocation, not just the individual assets they have, such as their IRAs and cash, but also all those different income streams, real estate property, etc. And then we're going to take a look at those liabilities and just determine, is retirement even possible? What type of rate of return do we need in order to be successful during our retirement years? If we've determined that we can be successful and we don't have to take on an excessive level of risk, now we drill down to really what we think of as a specific purpose. It's really the possibilities into the priorities. And now we identify what the most important things are to your retirement. What are your needs? What are your wants? And also, what are your wishes? We may not even get to that wishes point. We may say, you know what, I don't have any wishes. I just want to know that I'm okay, take care of our needs, take care of our wants, and everything else will fall into place. After we've figured out what those possibilities are, what those priorities are, then we can move on to the actual investment allocation. Unfortunately, most financial advisors are really trained more in investment planning than anything else. And it starts with that modern portfolio theory. It starts with the asset allocation mix, and that can be the biggest mistake that you make. Unfortunately, that's what it feels like. Maybe you've felt this before. You walk into your financial advisor's office or you walk into a broker's office and say, hey, I've got the perfect solution for you. Here's the perfect investment. It's average 6% a year or 10% a year. This is the solution for your retirement future. And it really shouldn't start there. It should start with a series of questions to identify where you're at today and where you want to go so that we can determine if we ultimately found the right allocation in the end, in the first place. And once we've determined that, then we can stress test that allocation. We can stress test it based on historical returns and future potential returns, in addition to inflation rates and rising taxes and fluctuations to when you might actually pass away, which is also a risk to your overall retirement. How long am I going to live? You have to take into consideration all of these things in order to truly build a comprehensive financial plan for your retirement future and give you the security that you deserve.
So Casey, how much time is it going to take for you to come up with that plan?
Well, typically we have a three-step meeting process. In that first meeting, we're sitting down, and it's kind of like an interview. We're just getting to know each other a little bit better to determine if we can possibly even accomplish your goals and ultimately add value to your life savings and be a fit, because we're not a fit for everyone. As we go through this three-step process, let's say on average, we've got about 6 to 8 hours in the actual planning process, one-on-one with the individuals that we're working with, depending on how willing they are to put in that time as well. Then on the back end, my team has a couple hours of time that they're going to be putting in, analyzing where they're at today and putting that plan together for the future. And then I'm going to also be spending a lot of time with my team and our team of certified financial planners so that we have two heads, because two heads are always better than one, in order to really build that plan. And that might be another couple hours. So I'd say on average, it's about 12 to say 14 hours that we've got into building a plan before we ever actually implement it. And I bet that's a lot more time than you've ever actually spent planning the next vacation.
I'll bet that's true. I think the best use of your time is to pick up the phone and call the number on your screen right now. Be one of the next 10 people who call and get in line for a complimentary review of your entire financial and retirement plan. We'll take a look at exactly what it's costing you now to work with your current advisor. We'll start working on strategies to help you minimize taxes and maximize the amount of money you keep, and then a lifetime income revenue plan so that you will always have that confident retirement that you deserve. Those three things for the next 10 people who call the number on your screen. Start work now, meeting with Casey or a member of the Howard Bailey team so you can have your very own purpose-based retirement. That's all the time we have this week. We'll see you next week.